Alrighty, guys. Well, let's go ahead and get started. Um, First things first, I want to introduce some amazing guests, speakers we have on this call today. First, we have Garron Mattison of KNR Strategic Partners. I cannot speak highly enough about these guys. A little bit of background on my end. I was very frustrated for probably about the last 7 years. I've switched different accounting firms probably 5 or 6 times. A little over a year ago, I think it was, I found these guys, and these guys are just absolutely amazing. They can do everything from tax strategy to bookkeeping to getting advice for accounting needs for acquisitions or selling of a business. So they're very well versed. Once again, I cannot speak highly enough about them. So very glad we got Garrett today. He will be doing a deeper introduction of himself when he gets started here in a bit. And then we've got Tim Coons, and I already apologize to them, but we also have Cameron Mitchell, who are both amazing attorneys and partners at Counxel Legal Firm. They have been helping me for, I would guess, probably almost 10 years or so with different legal needs. And I just like to give a shout out that if you need any help, whether it's legal or accounting, I highly recommend these guys. And they really are experts at what they do. So we are very fortunate to have them on this call today to help us with our topic of succession planning, specifically for Medicare and health books of business or agencies. And we all need to be planning on that. Even if you're not planning on selling, you never know if an accident or tragedy strikes. You need to be well prepared for transitioning and the succession of what could happen. So I'm going to get started personally. Just to give a little bit of background, I know a lot of people know me. I'm Zach Markham, one of the co-founders and presidents of Fidelis Consultants. I have, over the past 10 years, bought or sold about seven different agencies or books of business. So I have very firsthand knowledge in what it takes to buy a book of business, and I can understand, obviously, from the selling side what that looks like as well. Not only have I bought and sold books of business and different agencies, I have also consulted many people on just the logistics of what it looks like to buy a book of business and help them through that process. It can be a little daunting, but I'm very confident with the right partners. It's not difficult. So um, I will give you some of my initial slides here on just some advice I have. Then I'm going to turn it over to these experts here, and then we'll get going. So today we're going to cover succession planning due to retirement, or if you just want to sell and get out of the business, succession planning due to death, tax implication, and just legal planning and pitfalls. So all good topics that I know we get asked questions in regard to these items all the time. So I'm hoping you guys are very excited that we finally put this together to hopefully answer a lot of these questions for you today. Okay, so I'm going to talk about specifically on my end, just a bit of succession planning for selling your business. I know a lot of people have questions on how to set up their estate or their will to be ready in the event of death. I'm going to leave that to the experts towards the end here, but I'm just going to specifically talk about selling if that's something you're interested in. So, how can you set yourself up for success now, and what should you be asking yourself if you're looking to sell? So these are some questions, whether you're looking to sell right now or in 5 or 10 years from now. I can tell you in the different acquisitions that I've done and that I've seen, you definitely want to be organized. I know that seems kind of common sense, but I can't tell you how many times I've seen very unorganized financials, uh, record keeping with clients, and just anything in between. And it just decreases the valuation of the business that you're able to sell. So how are you holding your current clients? And this is something I know that the guys at Counxel will go over. But are you selling in your personal name, or you do it under an LLC? So something to think about. Do you have a CRM? If not, I highly recommend you get one. It'll make the selling process much easier. Do you have clean and organized financials? Very important. If you don't, I can promise you it makes it a lot more difficult to sell your book of business. And then these other questions are really more so to help you in that simple transition. What are you concentrating on now? If you want to elevate your sell price, this is something to think about. And I'll go into that in a second. What products do you focus on? And there's a very specific reason. I have this last bullet point. Have you bought any books of business in the past? Because that can derail you. And I've seen that happen to a couple people in the past. And it's kind of a weird situation, but I'll address that in a second here. Okay, so how do you sell it? So a lot of people say, well, I know I want to sell, I want to retire, whatever it may be, but I have no idea how I'm going to sell it. So we've tried to make this as simple as possible. There's a couple different ways you can do it that we can help at least facilitate. So Integrity has a company that has partnered with them called Access Capital, and all they do is buy agencies and books of businesses. So it's a very simple process. You send them your financials, and within a couple of weeks, they'll have an offer ready for you, and they can close very, very quickly. So that's the huge advantage of going that route. I will say many times that offer won't be as high as going these other routes, but you will get a quick close and they will fund it quickly. Uh, you can find an agent within the Fidelis hierarchy that would be interested. In fact, we keep a whole list of agents that are looking to acquire books of business. And I've done this actually probably about 5 times in the past year where somebody says, I'm looking to retire. And within a week or two, I have one of these agents on this list that's in contact, ready to buy that book of business. So that's an also very quick way to sell if you're looking to do so. And lastly, if you just say, hey, I want to go on the open market, I just want to see what offers I can get. There's a list of business brokers, and it's kind of what they specialize in is insurance book of business sales. We could just give you that list, and you can feel free to reach out to them and go down that route. Now, if you're looking to do this, as I mentioned before, you want to get organized. So get these things ready. A breakdown of your book of business. You don't want to put any identifying information in there. So don't put names or Medicare numbers or anything like that. You don't want to get in trouble. But you can simply just put a list of how many clients you have, where they're at, product type, effective date, and that can at least organize a list of your clients so that people can see how many you have active on your books. And then you want to really have good financials, as I mentioned. So I just listed out here what you want to have ready. This is what people are going to look at. No matter which of those 3 options you want to do, they're going to ask for those items. So have that ready. And if you don't keep a P&L or balance sheet, you can get the help of an accountant. As I mentioned here, we got Garron here on the call today. I'm sure they would love to help if you need to do so. And lastly, just year-to-date financials for the current year you're looking to sell in. So how does that look? Okay, so now you kind of understand these steps. What is the process? So I'm sure the guys at Counxel can go into more detail than I will, but I can tell you what I've seen in the past, how it typically goes. You'll negotiate a letter of intent. Then from there, you kind of get the terms set out. You'll negotiate language in the actual purchase agreement. Once again, the legal experts will go over how that will look. And then you'll set a closing date in terms for transferring all of the carrier contracts. And then you guys will complete those succession agreements that the carriers require. They have their own paperwork you have to do to transfer from one agent to another. We can always help at Fidelis with what that paperwork is. And then you'll typically stick around for a couple months. So the buyer will want you around in case they have questions. Typically, it's just like a verbal, you have to be, or not verbal, I'm sorry. It's just that you have to be around by phone or by email for a couple months in case there's questions. So pretty simple process. This can get more complicated if you're selling like a big agency and there's a lot of employees or whatnot. But for the most part, what we see is books of business, and it's this simple of a process for the most part. Okay, I debated even putting this slide in because this question gets asked all the time, and there's really no perfect number here. But this is just, as the asterisk below says, it's a general range. This is what you're looking at. If down the road you're looking to exit the business or retire, whatever it may be, this is kind of the price range you're looking at. If you have a lot of IFP, individual health family plans, Obamacare type products, those do not sell for as much. A lot of turnover in that business. Buyers and investors don't really like buying it as much. So you're going to get a multiple valuation of 1 to 2 times your annual revenue of those products. Medicare is much more valuable. Specifically Medicare Advantage is where you're going to get to see the top purchase price offers for. That's kind of the most coveted as far as what investors or buyers like to see as far as stability is concerned. But a lot of things, that's why there's a range there, 1 to 2x or 1 to 3x, will determine your price on what your book of business is worth. So it's product type, as I mentioned. If you have a lot of Medicare clients, but the majority are Medicare supplements do not sell for as much as Medicare Advantage clients do in a book of business. So you're going to see that multiple diminish on your end. Client retention, how well, if your clients are in a county that sees a lot of turnover, once again, that's going to decrease your ability to sell a book of business. Geography, that can definitely determine if you're in a market that has a lot of turnover, once again, kind of like the retention, people may shy away from that, decreasing your book of business price. The size of book, this is one thing that catches a lot of people off guard. If you have less than 100 clients, you're going to see that your value is lesser because there's not as much risk spread across, 2, 3, 400 clients. So if you have one bad year and you have 100 clients in one county, the buyer sees that as a high risk book of business. They could lose it all if there's not as many clients spread across multiple counties. Interest rates, we're seeing high interest rates right now. I can tell you right now, books of business do not sell for as much as they did 4 or 5 years ago. And that's just purely market based because the loans cost more to get. Then lastly, this is why this is bolded and underlined. This is one that surprises people a lot, but it makes sense once you understand it. The time of year will be one of the biggest factors of getting the best price for selling. If you try to sell right now through September, you're going to get a lower offer. Buyers see this as high risk because we're right before AEP and they know that they're going to lose some chunk of that book. Best time of year, you're going to be selling in February or March, right towards the end of OEP. Buyers love that because they know they've got kind of a year locked in where they're making their money back off of what they purchased it for. So keep these things in mind. If you want to get top offer for your book of business, I can tell you these will all factor into your multiple that you're going to get. Okay, so lastly, before I hand it over to the experts here, I got some helpful tips. I already mentioned this. Some carriers' production work is not as valuable as others. Not to say you're not always going to do the best thing for the client, but I'm just telling you, some people are a little surprised by this. Certain carriers are difficult to transfer. So buyers or investors do not like buying certain carriers versus others. Same thing with the products. If you have a lot of ancillary plans, or like I said, Medicare supplement type plans, those may not value as much as some of your other books. So just something to keep in mind. And then just so you're aware, large national carriers will usually be a lot easier to transfer. United Healthcare and Humana, you can transfer those guys in like a week or two. Very easy. It's like a one-page form, very simple steps to transfer. You get into those local or regional carriers, and sometimes they have steps that just take months or they don't even have a process, and it's extremely difficult and it scares away potential buyers. And then some have unique stipulations. So for example, United Healthcare, if you've bought another United Healthcare book in the past, that's part of your current book of business, they will not let you transfer that book of business again. They only allow one successor agreement. So I've seen deals where it gets stuck because they cannot sell their United book of business since they've already bought another United book of business. Kind of strange. I know. I've gone through this with United Healthcare before. There are ways around it, which we could talk on a separate call individually about, but it does create some hurdles in those situations. And then one last tip, some people get so stuck on if I'm selling my book, I got to sell the whole thing. You don't have to. If you're looking to retire or just kind of scale back on your stress, you can just sell away the carriers that have the bulk of your business. Maybe United and Humana, and then you keep some of the smaller carriers. That is an option. So those are my tips I leave you with on my end. But without further ado, I really want to get into what the experts here have to say. And I'm going to pass it on over to Garron from K&R Strategic Partners to tell us all about the tax implications of selling your book of business or agency.
All right, hey guys. My name's Garron. So I work at K&R Strategic Partners, one of the managers here. Let's see if I can change this slide. There we go. All right, like I said, I'm one of the tax managers here, CPA, enrolled agent here, working in the tax and accounting field for about 7 years. But our firm works with a lot of agencies, a lot of dental practices and stuff like that. And so we see a lot of business sales, a lot of purchase agreements and stuff like that. And so we're really experienced when it comes to stuff like that. Or if you just need general tax planning, accounting needs, if you're wanting some clean financials, that's all stuff that we're really comfortable with. Let me get into it. All right, so we'll start off with business structure just because taxation really starts at like what your structure is. And so there's really four general structures that I'll go over. First one is going to be the most common is a sole proprietorship. Sole proprietorship, you don't really have any structure. You're just starting a business, or you have an LLC and that's really it. You don't have any partners, or you haven't um, elected to be anything else. And so at that case, you're just going to report all your taxes on your personal tax return on Schedule C. Everything you make is going to be subject to self-employment tax. Partnership is just basically the same thing, but you have a partner. And so in this case, partnerships file their own tax returns, Form 1065, and anything that's your income or your portion of the income is going to be reported on a K1 that you get after the partnership return is filed. It's going to show all of your sources of income from that partnership and your portion. It's called the S corporations and partnerships are both called pass-through entities. So typically you're not going to have any tax liability at those levels, just at the personal level. So you'll see all the business income flow to your personal return. And so for the corporations, usually the default if you start a corporation is a C corporation, and generally not the most tax efficient way to do it. C corporations have a tax at the business level, and it's 21%. And then once you send income to yourself as a dividend, it's taxed again at your normal tax rate. And so C corporations is generally not the best way to go. S corporations are kind of a mix of both a partnership and a corporation. Still a pass-through entity, but you don't have that double taxation. So your tax rate's based on your individual tax rate. And so if you want the most tax efficient, especially for agencies, you're going to probably want to go S corp route because there's no double taxation. The amount you get isn't subject to self-employment tax, and then you do issue yourself a W-2. So it does open some routes if you want to do like some retirement planning, like starting on your own 401k. Also makes you look better for lending purposes. So we generally will recommend doing an S corporation once your net income is about 30 to 50,000 is usually when it makes sense to do that. And so not really any advice about selling your business, but just want to get you up to speed when it comes to like, your structure. And if you need help setting up structures, if you just have an LLC, you want to be an S corp, definitely something we can help with.
Hey, Garron, on that real quick.
Yeah.
The legal and the tax structures, sometimes people get confused. They are separate, the terms that you use. So when you say S corp, you can be an LLC taxed as an S corp. It's an election that you make with the IRS. You could also set yourself up as an actual corporation, entity structure wise, and select, obviously, it's a default C corp. Partnerships is another one that people always talk to us about. Really, partnerships can be LLCs where you actually are taxed as a partnership. And so I just wanted to make sure everybody's clear. The default that most of us are going to be talking about today will be LLC structure, with what you're talking about here is a designation on the tax side of S corp or partnership, the designations. But yeah, sorry about that.
No, that's a good point. So the LLCs are really flexible. We love LLCs. Because you can do a lot of things with it. You can have other members in your LLC and be treated as a partnership, or you can elect with the IRS to be an S corporation to be treated that way. You can do the same thing if you're a corporation, just make an election to be treated as an S corporation. And so, yeah, thank you for that point there. Another thing that you'll commonly see is this strategy of having multiple entities. Like if you have partners maybe in a different agency, it's smart to have one S corporation where you kind of like is like your parent company where all your operations flow through. And so, like I said before, partnerships are generally subject to self-employment tax, and the S corp doesn't have a self-employment tax included in it. So if you have a partnership owned by an S corporation, all the income flowing through to S corp won't have that self-employment tax. So you'll see this structure a lot. And if it also make it easier if you're selling an agency, maybe you have an LLC that's owned by an S corporation. It kind of just like breaks out your different businesses. So if you have multiple businesses all flowing into S corp and you want to sell like maybe just one of the LLCs, just makes it easier so you don't have to like break up your S corp at all. All right, so let's get into the selling of the business. So generally, you're gonna have either like an asset sale or a stock sale. So it's stock sale, like you're just selling the agency or parts of your agency. Stock sales are typically better for the seller in the point of you'll have a better tax rate. Asset sales are typically better for the buyer if there's more tangible assets, like if you have inventory or stuff like depreciable assets like vehicles or like computer equipment, maybe some desks, stuff like that. Those are subject to depreciation recapture, and you don't get as good tax rate with that. But if you're selling a book of business, that would be an asset sale because it's one of your assets, and it's an intangible asset, and that would be under capital gain. So you're getting the same rate for stock sales or an asset sale if you're just doing the book of business. And so the different rates here are going to be like if you have inventory, I know it's probably not in your guys' case, you're going to have inventory. That's like tangible things that you're selling. So maybe not in your case. Maybe if you have like, I don't know, like a podcast where you have like merchandise and stuff like that you're selling. In that case, that's subject to ordinary income. So whatever your ordinary individual tax rate is. Equipment, like if you have some computers or any other equipment like that, you're going to get depreciation recapture. So whatever you depreciate in the past is going to be recaptured. The tax rate's about 25%. And then intangibles like goodwill, book of business, stuff like that is going to be at a long-term capital gains rate. As long as it's if you've held it for over a year, then it would be considered long-term. If you've only held it for a year or less, then it's going to be at ordinary income rates. All right, so here's kind of a broken out. So ordinary income, that's going to be your marginal tax rate. So based on what your personal income is going to show like what your tax rate is for the business sale. Depreciation recapture is going to be 25% to 35%. And then long-term capital gain rates are going to be either 15% to 23.8% is the max you can get for long-term. So definitely better way to go. Long-term capital gain can even be at 0% if your income's under a certain amount. I have it here. So if you're married and your income with the sale is under 96,700, you're actually at a 0 tax rate. So in those cases, it's nice. And then it's 15% until you get to, if you're married, it's 600,000 for 2025. And so typically you're going to be in the 15%. And then once you go over that, it's 20%. And then there's an additional tax rate or net investment tax is also applied. That's 3.8% if your income is 250,000 or more. And that's just on any investment income you have, which this would fall under. So that's the general tax rates there. Let me go to the next one. All right, so we want to plan things in advance. The best thing you can do is just have a clean set of financials. I know Zach mentioned this earlier, but it's super important because when you're buying a business or you're trying to get a book of business, you're gonna want to know what their income is. Like that's the That's the main thing you want to know. And so you want a clean set of financials. And what's going to happen is if you're working with a broker, they'll probably do this for you, or you can work with us and we can help you with that. But they're going to separate personal stuff from business. So if you have a lot of things that maybe wouldn't apply if you were to sell your business, so like a lot of times people will like pay their kids like a salary, and in their case, if they buy the business, they wouldn't have that, and so that would be kind of an add back to your financial statements, to maybe increase the net profits. And then if you have like any owner perks like that you would just get as an owner, maybe if you're paying yourself like an excessive salary or not paying yourself a salary, we'll probably normalize that. Like, what's the industry standard for your own salary in that business? Stuff like that, and add backs are generally going to be done by the broker, but we can definitely help with that too. And then there's room for negotiation when you're selling your business. So you want to kind of plan for getting obviously you want the capital gain rate. And so when you're selling your business, you kind of have to allocate, if you do have like assets and stuff, you kind of want to allocate as much as you can to get like more goodwill, or your book of business allocation. You want more allocated to that, more than like inventory or tangible assets, because the tax rate for those are less good. And the buyer is going to be wanting the opposite of you. So you'll have to negotiate that. Another thing you can do to kind of spread out your taxable gain is doing like an installment sale. So when you sell it, you're going to get it in installments. So if you sold your business for, let's say, $500,000, and that would be, and maybe you put in like $200,000, so your gain's going to be $300,000. And so whatever that percentage is, you're going to look it up real quick. I should use easier numbers.
Hey, and Garron, I love that. While you're looking that up, one thing that's funny, and this is where having a good team working together, accountants and lawyers, is fun because we're always advocating, hey, don't take money and delay the payment, because what ends up happening sometimes is the buyer will hold that over your head if there's a lack of performance on the book or something of that kind. A lot of times there's indemnification provisions in your contracts and your purchase agreements. So we work together with you guys on accounting side to say, hey, what's the best way that we can minimize taxes, but also remove the risk of you actually getting the money? So I do love that conversation always comes up in the sale of a business, and it's something that we talk about at length. And a lot of times it's the risk tolerance of the person who's in the sell spot, to say, okay, I do trust the people who are buying, or I do feel comfortable allocating this as a risk money, monetary gain. And so if I don't get it, then I'm okay. But yeah, go ahead with your tax rate.
Yeah, I love that. I love the having the team, because we always want a legal team too, because there's a lot of tax stuff that may like mess you up legal wise. So we like to have both perspectives. And so I love that you guys are here. But in my example, so if you got 500,000 for your business, and the taxable gain is going to be 300,000, the gain rate is going to be 60%. So whatever money you get, 60% of that is going to be taxable. So if you're getting it in installments and your gain rate is 60%, then 60% of whatever you get every year, that's going to be the tax proportion. So it's a nice way to kind of break it out, so you don't have to take a whole lump sum in the year that you sell. The other thing to plan out is like your gain is going to be included in your income, and so that'll affect like your tax rate. And so maybe like you're close to going to like the 20% tax rate, or getting the extra 3.8%, and you want to kind of stay under that. Planning out the installments in that case, um, can you can like miss out on that 3.8%, depending on what your installment is. And so just a good planning rate, and it's kind of hard to tell. So definitely want to meet with a tax professional before, kind of map it out, just to get the best way. And then we'll go over a little bit of like when you die, if you were to die, and um, your business goes to like your beneficiaries. Death, obviously not great for you, but it is great for your beneficiaries because you get a step up in basis. And that just means like when you die or when someone dies and you're the beneficiary, your basis in that asset or business or house or whatever it is going to be the fair market value. So if you were to sell whatever you got for inheritance the day that you got it, you wouldn't have any taxable gain because your cost basis is going to be the fair market value. So whatever you could sell it for on the day that you get it would be your basis. And so really nice, especially if like we get a lot of questions here, like if you mostly if like you have like large assets like a house or maybe a bunch of rentals and stuff, it's usually better to just hold on to them instead of like gifting them. Because if you gift them to your descendants or beneficiaries, then you don't get this step up in basis. And so generally you just want to hold on to it and wait till you die. Obviously you want to have some good legal instruments in place, like a trust or something. I'm sure these guys will go over that. A lot of things are going on with when you die, and I know there's special rules when there's businesses involved. Probably want some buy-sell agreements or something like that, and I'm sure they'll go over that. But just wanted to briefly go over death and how that step up in basis works. And then yeah, that's all I've got. Open for questions. If you want to schedule a chat with us, kind of go over a discovery call, see if we're a good fit, you can use this QR code. But I'll open it up to you guys for any questions you got.
Yeah, guys. So right now, if you guys want to ask questions specifically relating to accounting or tax questions, yes, please go ahead and ask Garron. One thing I will add, just I know I've already shouted out KNR, but one really neat thing, because Garron mentioned a lot about the tax liability you'll have by selling. So they'll do, if you work with them, and I know there's probably other accounting firms, depending on what state you're into, that can do this, work with a strategy as well. Like it doesn't mean if you have a $300,000 gain that you got to just go get wiped out in taxes. Like there's things they can strategize with you with, so your tax gain is much more minimal there. I know we had an agent sell, I think a year ago, that was going to drop the insurance career and go into real estate, and they didn't realize when they sold how many tax advantages they had by doing that. Because they were going to go buy rental properties and do different things there. So just keep that in mind. I would say a scheduled chat with these guys can be very, very valuable to you. So anyways, I'll leave it out and open to questions now if anybody has any.
There's a
Oh, I
couple
see there's
questions
some.
coming through chat. I can
Okay, I
see.
see
You see
those.
those, Garen?
Yeah, I don't know if everybody's muted, so we can do the chat.
Yeah.
All right, is there a way to estimate how much your book of business is worth? Kind of hard to say. Kind of depends, like what Zach was saying, like time of year, like what kind of clients you have. A good way to estimate is just like kind of go off like what your net income is, and like your cash flow, and then usually like 1 to 2 times that is going to be generally what it is. What about if you're a single mom? Single mom, if you would be at the head of household tax rate, and so if you just Google like long-term capital gain rate for head of household, I can look it up right here too. So it's gonna be similar. So for like if your capital gains is 0 to, or if your total income is 0 to 65,000, then you're gonna be at that 0% rate. And then if it's 566,000 is when it jumps up to 20%. And so just different income thresholds. If you're a single parent, you'll be at the head of household status. Can you receive the proceeds of a sale into a trust to avoid taxes? No, generally not. The trust is going to trust work. You're either going to pay taxes at the trust level, or you're going to pay taxes when that money gets distributed to you from the trust. And so not really a way to avoid taxes, just using the trust. Is it best to deal with your home license state, or what if you have multiple state books of business? If you have I'm not sure what your question is. So is it best to deal with your home license state? So if you're trying to sell to someone in your home state?
I can answer that to a certain degree. I mean, when you're selling, it's going to be a little harder, obviously, because you're gonna have to find somebody that's licensed in all those states. Um, but it's not impossible. I mean, it's not hard. People, the one good thing I will say about selling your book is it is in demand. Like you will get offers very quickly. This is a very coveted thing. People want to buy books of business. I mean, to them, it's like instant revenue, right? It's not like buying the local, bakery down the road where you got to keep a whole operation running and cash flow and so forth. So you will find buyers. It's just a little more difficult if you're spread out across different states.
Nice. Someone's driving, please be safe. Yes, you will receive a recording of this, is what I'm told. And then, yeah, you'll get these slides for Ed.
And Garron, on the trust question, I think some people have heard of overseas trusts as well. I think that's a concept that many people have. There's advanced tax strategy that you can get into. The actual proceeds from the trust, though, at the level that we're talking about, those are multi-million dollar types of operations that are typically engaging in that because the cost and expense of doing that is not small. But just a regular trust doesn't shield. It's funny, people think trusts actually shield people from liability or from tax disadvantages, but the only thing that a trust does is it helps you transfer assets at the time of death without going to court. Now, there's also an estate trust, an estate tax that is allowed each year. You have up to a certain threshold that is tax free when it's transferred through a trust, and or not even just through a trust. It's just anytime assets are transferred. So there's those concepts that a lot of times we work through with people when we're talking about what is a trust, what is a business, how do you help, how do you use them, what do they do? Those are all great questions, though. We love trying to help minimize tax liability as well. I will give a great shout out. I've used K&R and referred them many people, including Zach. They are a great team. One thing that you'll hear a lot about from them is ways that they can actively help you save money. I'm a big proponent in my own practice on we're not here just to protect you from liability, but to make you money. And that's the same way K&R Tax approaches their business, which is, hey, how can we take advantage of these different things? For instance, on the sale of a business, Garron may not talk about it with you today, but they have 2 or 3 different strategies they can employ immediately if you're going into a higher tax bracket. Some of them are relating to oil and gas investment, which has a high tax deduction that you're allowed to take the first year. Some is equipment rentals that you can put money towards that has a high deduction in the first year. So there's a lot of things that are really exciting, and you don't have to wait to sell to use them either. They're incredible when you're operating a business. We love having them involved. So the other thing, Zach, before I jump off and give you the floor back here, the stuff you just heard from Zach is probably the most high level, intelligent thing you'll hear from anybody that's going to tell you anything about selling a business. He shared almost the entire playbook to you guys. Nobody does that. You guys just got the golden goose that just laid the egg. So I hope you guys really take that. His experience and knowledge is second to none in this space. And what he just shared is truly, I've never seen somebody share it as openly as he did. That's a true privilege for anybody that's on this recording to have heard what he just shared, because that is the mystery most people are worried about, how and what and all the logistics. So anyways, that's to you guys.
I appreciate it, Tim, and we try to find value wherever we can and give it back to you guys. So thanks for that shout out. And we do have another question that rolled in. Do they have to be licensed everywhere you are? Yes, they do. Most carriers will not allow the transfer to go through if you're not licensed. But what happens many times is the agent will just go out and get the non-resident state. Most states are pretty quick, unless it's like Florida, and for whatever reason it takes like 2 months. But every other state is pretty simple. If you are trying to sell to somebody that just wants to go and get licensed to take over your book. And one last thing I want to bring up, because I think it bridges the world of tax and legal, that I know we get asked all the time, so maybe you guys will both have an opinion on this, is a lot of agents, probably on this call too, are they always ask, should I write my business in an LLC or in my name personally? And my opinion's always been go get it in your LLC, because one thing I brought up earlier is if you ever sell your business, it's going to be a lot easier if it's held within an LLC. And especially, it's not always the case, but there's every now and then you got to sell it as an equity or stock sale. And if it's in your name, I don't even know if that's possible. And in the case that I brought up earlier with United Healthcare, where if you've already executed a successor agreement once, they won't let you do it twice. Really, one of the only ways around it is to sell it as a stock purchase. So if you ever run into that wall, that would be your saving grace, that you'd be very glad you did everything in your LLC at that point. So is that your guys' opinion too, to if you are writing now to try to transition it into an LLC?
Yeah, from a tax perspective, you're just having the LLC is nice because if you choose to maybe elect to be an S corp, maybe your income's not a lot to start out, which is fine. You still do the LLC because when you make the S corp election, you can actually retroactively do it to the beginning of the year. And so throw some planning in there, like maybe by the end of the year, like, oh, I have like 300,000 of income. If you didn't have the LLC, you wouldn't be able to be an S corporation for that year. And so you have to pay a bunch of taxes. And so definitely good to have the LLC.
Yeah, yeah, and Garrett, on that point, so people may not understand that to the tax effect, which is if you are an individual writing business as an individual without an LLC, your tax is a sole proprietor, which means you have self-employment tax that's being allocated onto you for every dollar that you generate. Whereas with the S corp election, it allows you to bypass the a large portion of that. You still have to write yourself a salary, a reasonable salary, but for most of your gain, most of your revenue, you can push that into a draw or owner draw, which is not taxed with self-employment tax, which is 13.4% or somewhere, depending on the state,
15.3.
13.3%, which is huge. You know, that's a huge savings. So that's why from a tax side, it's critical. From a legal side, it's critical because if I do all the business in my own name, again, part of what we do is risk allocation. You are completely you're completely open to all risk, right? You, your house, your spouse, everything that you have or own is now subject to liability of anything that you do wrong within the business that you're operating. Whereas with an LLC that's perform and operating correctly, it actually protects you. It's a separate legal entity that protects you from personal liability in large part.
Yep. Appreciate that. And two more questions to add to that. So not just get paid into the LLC, also write into it. Yeah, so you want the business holding your clients, the LLC holding the clients, because otherwise it doesn't really effectively mean anything, is how I understand that. So yes, to answer that, Kelly. And then as an LOA, Joanne, your situation is a little different because obviously you own an agency. So you can do it that way. That would be the simplest way for you. But for somebody that's just their own agent writing their own business, you would want to just be the actual agent, not an LOA. For S Corp LLC, is there a threshold that makes it best based upon cost and paperwork for LLC? I'll let you guys answer that.
Yeah, for LLC, then not really a threshold. You probably just want the LLC to start with. For S corporation, the threshold's probably going to be about 40,000. Is usually when the extra admin costs like payroll, stuff like that, kind of breaks even with the tax benefit. So usually around 40,000 is what we recommend.
Great.
Agreed. And again, one of the beautiful things about K&R is they'll help you understand what you're trying to do if you're a sole proprietor is you're trying to minimize your gain by expense and anything that you can draw against that income to make it look like you're making as little as possible. So that's why that $40,000 threshold, it's usually getting eaten up by a lot of your expenses in the business so that you're effectively not having to pay a lot of tax. There is a level of formality to electing an S corp. You have to run a payroll, for example. So each quarter, at least, you have to run a payroll or phantom payroll. It has to be submitted through IRS with your state agencies. So there's a formality there, which is really, I think, Garron, what I've seen a lot of times is the hindrance to saying, hey, yeah, everybody should go straight S Corp. Well, if you don't have enough revenue to go through the formalities that need to be done for an S Corp, which isn't a ton, then don't do it. But if you do, yeah, it's the easy no-brainer.
Yeah, and so that 40,000 would be like after all of your expenses. So if you have a
Yep.
bunch of expenses that you're writing off, not going to be making sense to be an S corp if it's bringing you to a loss or under 40,000.
Yep.
Okay, a
Awesome.
couple more questions. Been selling as 1099. Can I move my book into an LLC? That's a great question. Yes, you can. It's a bit of work that you're going to have to do. And remember, with United, you're going to have to sign one of the successor agreements from your personal name into your LLC. So you've now used your one-time successor thing with them. So it's better to do it, in my opinion, just get it done. But yeah, there's forms, every carrier is different, how you transition that over. Some are just ridiculously easy, like Humana, it's like one page and you get it done in like a day. So it really depends on the carriers. So Mike, reach out if you want to discuss that more in detail, how that would look. But yeah, it can be done. Okay, I think that's all the questions. So I think we're ready to roll over and to the next part of this and go into the legal chat with the guys here at Counxel. So Tim and Cameron. So I think you guys have control, so feel free to take over here, guys.
All right, we're going to test out the controls. Oh, is it down at the bottom there? Hey, so we're excited to be here again. I can't speak highly enough of both Garron and his team at K&R, and then Zach and what he does. And again, the information that you guys have shared today is incredible. One of the things we love talking about is how do we make you money? How do we not kill deals? And how do we save you from risk? I think a lot of attorneys are really good at saving people from risk, or they look at risk all the time and they say, don't do it, don't do it, don't do it. And what you know as a business owner is you have risk, and that's part of the game. So we love to look at deals and say, how can we make this happen in the best way possible for you? So Counxel Legal Firm, we have 4 partners here. Cameron and I run the transactional team, which is the non-litigation. So anything from LLC formation to contracts, drafting, writing. We'll talk about asset purchase agreements, membership interest agreements, stock purchase agreements like we talked about today, and how to minimize risk there. One thing we really are passionate about, we have a program called Counxel on Call, which is a monthly subscription. The worst conversation that most people have with their attorney is you're sitting there on the phone, you're saying, "Hey, how's your business going? How's your family doing?" And the first thing you're thinking of is, "Are you charging me for this?" Well, guess what? Most attorneys do. That's the crazy part about it. We don't. We love this program. That's why we do it. We're here to help you actually make money and enjoy running a business. We're passionate about entrepreneurship and business ownership. So it's a big part of who we are. I'm the founding partner, come from a long line of entrepreneurs, really passionate about it. I'm obviously a big talker as well. So I'm going to actually give Cameron the floor here.
Hello, everybody. I guess it's morning for us, but I think afternoon for most of you. Like Tim said, my name is Cameron. I've been working with Tim now for 5 or so years. And like you said, most of probably 99% of what I do is on the transactional side of law. So helping people like you buy or sell businesses, start businesses, form LLCs, draft contracts, review contracts, pretty much anything that you may run into on a business, by a business owner. It's the stuff that I and we help with, and the Counxel on Call program is great. I tell everybody that I talk to about it. It's a great way to be proactive with legal questions, as most things that we get are all reactive, right? People tend to not think about the legal issues until those issues arise, and so the Counxel on Call, breaking down the barrier to kind of the barrier of entry to the legal advice and legal questions, helps to get out ahead of those sorts of things and be proactive, so you guys can focus on growing the business.
Yeah, so with that, one thing that I just worked on with a Counxel on Call client was, as you're growing your agency, a lot of times you don't start very compliant, right? Maybe in your formation, maybe in your operations, maybe with your contracts with your team, or whatever else may be the case. And a lot of people get a little embarrassed, right? Oh, I didn't do it right. I didn't, quite have that down right. So maybe I won't talk about it. It'll just go away. those issues become exposed at the time you're looking to sell. That's why we love talking about them early. Is if those things are not buttoned up at the time you're getting ready to sell, it will definitely impact your sell value. So our goal is to make sure everything possible can be buttoned up, and there's really no secrets when you get to a sell. It is literally you show everything because they need to know as the buyer, what am I buying? And if you don't show everything, or if you withhold something, obviously it becomes an issue later on in the after sale process, which we've helped people through litigation on that. We have 2 partners that do litigation specifically. So getting that buttoned up is really important. The transfer on death provisions are critical. We talked about in Garron's slide, death not great for you, but great for your beneficiaries. Truth. It can be really great for them if you have the right things in place. A lot of people get stuck without things done correctly, and that means your beneficiaries may get a tax advantage from it, but they're having to go through court and be in a long, drawn-out battle. You and your siblings, perhaps, over or your children over this issue. So properly documented upon death type of transfers. Most often, where you're going to see these provisions is in your LLC operating agreement, or sometimes people call it a partnership agreement. Even if you don't have a partner, an LLC can have a map, a roadmap for what's going to happen upon certain things taking place. That's the operating agreement. So we always include a provision in there as to what happens upon death. Disability is another big one. Your disability insurance providers will tell you it's 7 times more likely you're disabled than you die. So yes, we do cover that. And then divorce, right? Those are the big 3 Ds that we face, which is death, disability, and divorce. How do you work through those? Many states, including Arizona, is a community property state, so ownership is held jointly for anything that you don't disclaim as sole ownership of your own. So your spouse does have ownership. Again, so things that you have to think through. Wills are helpful. We'll talk about broader estate planning issues, but a will, many people think of a will as it automatically designates what I get to my children or those who I want. Yes and no. A will is just simply your testament. It's actually called last testament and will. What then happens though is your heirs have to go to court. It's called probate, and it's a long drawn out process. It can become very sticky. It gets into questions of whether you had mental capacity to do it or all the other issues. And during this meantime, you have a book that's now sitting without an owner, if you're a sole owner of the book. And how do you get the transfers done so that the carriers are going to continue to allow you to have the business in place, right? The clients have to have somebody that's in place. So that's a big part of it. We try to avoid probate as much as we can. Last thing, and then I'll turn it over to Cameron. The transfer mechanisms, let's see. Yeah, so transfer mechanisms outside of death, we talk about these, which are the buy-sell agreements and your trust structures. Sometimes it's even beneficial, and people do this, to put your trust as the owner of your LLC, which then means all of your trust ownership just automatically transfers as designated in your trust, rather than having your ownership interest in your LLC be in your name specifically, and then subject to, again, administration by a trustee or probate court. So those are all things that we can work through. Sometimes within the carrier realm and within insurance specifically, they don't allow for you to have ownership by a trust because you have to have proper licensure, right? Licensure ownership is a big requirement in any regulated field, law, any securities, any insurance. Licensure is key. So a lot of times trusts cannot own the LLC itself.
And that, I mean, kind of brings us to kind of what we've been playing around with. And this plan, it's a combination of documents, like as Tim has said, and a combination of planning. Not only having the entity set up from the beginning or entity set up, before this all comes, to a head, but having everything in an LLC or a corporation or whatever that corporate entity looks like. And then a combination of, in the operating agreement, transfer on death provisions, as well as your estate plan, all working hand in hand to help effectuate the smooth transfer and transition whether that's to a spouse or a beneficiary or to a business partner, whatever the case may be, having all of that in place prior to some sort of event, right? That would trigger this. Estate planning 101, just very, very general, right? But whether it's a will or a trust, it accounts for the management and distribution of assets that can occur during the lifetime, as well as, and more pertinent, upon death, ensuring that those wishes are honored and through the different mechanisms, minimizing legal hurdles and protecting family and business altogether. Two very common instruments in estate planning that you'll often hear about, and people, I think, often get confused at what does what, but you have a will and a trust. Those are generally your major instruments that will account for the distribution of assets. A will, as Tim said, you have to go through probate. The court is involved to some degree. There are small probate mechanisms, but for the most part, you will have court oversight, expenses, et cetera, et cetera. A trust aims to get all of that out of the court and designates trustees and individuals to administer your estate upon your passing. And inside those documents, you'll have powers of attorney. Those are what helps while you are alive. I think a lot of people, both durable financial power of attorneys, healthcare directives. I think a lot of people are confused. I get people calling it, well, hey, my husband died and I have a power of attorney. Well, that goes away with the death. That's when then the will and the trust kicks in. Business succession planning, buy-sell agreements with your partners, whether that's a separate document or in an operating agreement, beneficiary designations, right? All of these things to plan ahead for, the worst case scenario. Not necessarily a conversation everybody loves to have, but it's a conversation certainly everybody should have and start thinking about.
And on that, a tax, the best way to start planning for that with trust work is we have a pamphlet or a packet that you get with all the questions that you'll need to answer. And it really does make you stop and think, oh, okay, what do I want to do with these different assets, including my business assets? There's a question here about if I don't have an LLC up and running, and I want to transfer to my spouse, how do I do it? Well, again, licensure is a critical issue within this space. So if you just wanted to transfer without her having proper licensure, you're going to be in a hard spot. That's just going to be a tough thing. So you can set up a pre-negotiated sell to somebody if that's something that we see that at times where you have this agreement. Hey, upon my death, you guys wanted to buy my business. Great. We'll pre-negotiate. Usually it's going to be a flexible price, something that can have a variable amount attached to it. You have to understand that you're going to likely get a lower rate or amount than what maybe otherwise would be available. And oftentimes it's going to be a not must or shall buy, but a could or maybe will buy, right? So there's not going to be anything pinning the person or entity into that space. So it is tough. If you don't have an LLC set up, it puts you in a really precarious spot if you do pass away or if you do become disabled, specifically with your book of business. So we really encourage that thought process early on. Setting up a trust can vary depending on the number of assets as well. So that's one of the questions. And I'm going to take just a minute to answer some of these because we're really going to jump into what I think is the more exciting part, which is about how your entity structure can really help you in a sell or purchase. But with a trust, it can range, right? You can have a small trust that has very limited assets. Those usually start about $1,800, or some of the more complex and heavy tax-focused trusts. I've seen people, and we don't do the heavy tax focus, meaning like multi-million dollar, again, overseas trust, limited partnership structures to limit your tax liability under a limited partnership, general partnership structures. Those are all very heavy tax advantage trust type work. Our highest range is $1,800 to $5,000. And then I've seen people spend, I have somebody that we send these to that's really high level that they can spend $40,000, $50,000, $60,000 a year because the tax laws change and how you structure your trust is dependent upon tax laws. So with that, let's see, do we have any other questions? Yes, revocable living trust, correct. If you do an irrevocable trust, Irrevocable trust is where you cannot change it. You actually lose access to the assets that you place into that trust. They are now controlled by the trustee, who cannot be you. Whereas a revocable living trust is a mechanism that allows you to use the assets during your lifetime while also allowing them to be transitioned post death in a way that's efficient for you and your heirs. Okay, entity structure, Cameron.
Yeah, so and we've talked about this on and off between, you know, Zach's comments and Garron's comments, and so we don't really need to dig, and Tim's also commented, right? I don't think we need to dig real deep into this, but generally, right, and you have, and you think about your entity type, and then with that you have your tax election or tax status. And so an LLC or corporation, either one would certainly be preferred over simply operating in your individual name as a sole proprietorship. From a tax standpoint, as we've heard Garron talk about, from a liability protection standpoint that we've talked about and we'll touch on. And then within those, especially with an LLC, you have the flexibility to, you know, maybe you start out, you're just by yourself, you are taxed as a sole proprietor for tax purposes, but you have the liability protection of the LLC. And then as things grow, maybe you bring in partners, you're taxed as a partnership, you make that S Corp election. It provides the flexibility while giving you the liability protection that provides. And not only does it allow you to provide clear financial and operational separation, but you should maintain clear financial and operational separation from your personal self to the business to help maintain that liability protection. And not only from a general best business practice, maintaining accurate financials, tax filings, etc., just from a basic operational standpoint, but when it comes to a sale, like Tim said, I mean, it's everything is out on display to that potential buyer, and having everything in place ahead of time will certainly aid in that process. There's so many times that sales come to a grinding halt because there's some issue with a document, with a record, something can't be found, somebody doesn't have something set up already. Having that will ensure, will help to ensure a smooth sale.
Now, a lot of the people on this call are likely more heavily focused on sales, meaning your personality type is going to be driven by going out there, achieving, succeeding, and really maybe extrovert type of personality style in large part. Well, these sometimes can be daunting tasks, not to say that you're not capable, because I feel the same, but it's not something that you get enthusiastic about, right? It doesn't have to be hard though. That's kind of the message here. It's really not that hard to do. And so please don't get discouraged over, oh my gosh, they're telling me all these tax things and all these legal things, and it's really, forget it. I'm just going to do what I do. You can continue to do that, but I'm telling you, it's not that hard to do these things. An extra 5% effort here is really what takes you over the finish line with these types of issues, especially when you have the right team in place. It doesn't have to be hard. So, plan for ownership transition. We talked about this. We have the buy-sell agreement. You have sometimes built into an LLC operating agreement what we call shotgun buy-sell agreements, which is if a partner wants to buy another partner out or a partner wants to leave, what's the sale price? Because one of the biggest hurdles or fights we face within partnerships is, hey, this partner's not carrying their weight, or hey, this partner wants to retire, but we don't know how to value the business. Well, let's get that done early. That's what we like to do. Let's get it done early before we have a fight over it. That way the business can continue to operate and be at its most efficient point, not get dragged down by conflict. The key drivers for a buy-sell agreement, that's just general buy-sell. Obviously, your contracts, your client lists are the key to what you have, right? That your client revenue is really the key to your book. One of the reasons Zach said have a CRM is not just because it helps you organize your clients, but it helps you understand what the value of your business is. And operational systems can help you actually efficiently transfer that system to somebody else, and that increases your value. I've seen many times in our buy-sell deals where having operational systems and efficiencies in place will increase the multiplier by a 0.3, 0.4, 0.5 because people feel like, oh, I understand what you're actually doing here. It's not just based upon your system of your brain. It's a system that I can duplicate. So big time there. So having that in place, the transferability, as Zach, again, incredibly provided to you some of the most key information you're having here, which is carrier transfer information. How can you do it? What's the process? And it sounds like Zach and his group are willing to help in that process when you have questions. That is worth more than you could explain to anybody. So, wow, use that if you're gonna go that route. Definitely use that resource.
So, kind of pulling this all together, kind of really the big major question that we're here to answer is, what does this process really look like for, for a succession plan? You've got a buyer, you've got these buy-sell agreements, right? What do we expect to see in one of these, right? What sort of terms, as Zach had mentioned earlier, one of the first steps is outlining terms in a letter of intent, right? What are we wanting to think about, right? And so one of the big things is how much money am I going to make and how am I going to get it, right? How quickly am I going to get it? And so there's lump sum considerations, there's installments, there's earnouts, there's so many different considerations that will impact cash flow, tax obligations and considerations, financial stability, right? Those are often the first part of the conversation is how much is it worth and how are we going to pay for it, right?
So on that point, Zach had mentioned earlier, integrity may not give you the highest price, and in fact, they may offer you something that's not even cash value initially. It could be a stock option within it. Those are pretty typical in the higher level private equity space. But we just had a client who did it the alternative route, which was they not in your exact space, but they sold to an individual buyer. They took a half lump sum up front with the 2-year payout for the other remaining portion of about $2 million. Well, halfway into year one, this people who are now operating the company ran it into the ground. Well, guess what? We're now left with a half payment outstanding to our clients of over $1 million, and they're not going to recover it because there's a defunct entity on the other side. So considerations being key is the dollar amount on the top end doesn't always mean that's what you're going to get. In fact, sometimes you have to say, this is what I tell everybody. I tell any client that comes, the amount you're getting up front is the amount you're going to have to live with because there's no guarantee you're getting anything else. So if you can live with that amount as your sell, even all these extra promises and guarantees and flowers and everything else they're going to throw at you, it's all a wish and a prayer because it's only as good as if it's going to happen. And there's things outside your control once you sell the business that you may or may not, be able to effectuate, including earnouts. Hey, if you continue operating the business for 2 years and you continue to increase the revenue threshold of the business, then you're going to be able to earn out X millions of dollars. Well, what happens when they put a hiring freeze on? What happens when they pull out some, pieces out from under you, maybe products that you were selling before that were very lucrative, but they say you can't sell them anymore? Those are all considerations that we take into effect.
Yeah, and then additional terms that you work through in these types of agreements, indemnification, right? What happens when something does go wrong, right? Who's going to pay for that? How it's going to be handled? There could be holdback money that is used to account for issues down the road. And then outstanding liabilities, right? Are there debts? Do you guys operate out of an office space that has a lease or part of the purchase? Are they buying your building or taking over the lease? Have you guys taken other sort of operational loans, right? All of these things going back to, it's important to have all of your records and everything straight so that when the parties come to the table, all of these things can be out there and to be discussed, to be worked out and accounted for in these agreements and in these, in this process. We've talked through the tax considerations, right? Understanding the tax impact, another reason, another plug for KNR, get with them early in this process, right? So that even if you're not thinking of selling even 5 years down the road, 10 years down the road, starting to understand what that would look like, what that could look like, how to plan and structure now for the future is, I mean, I don't think there's anybody that's going to regret having those conversations early.
Let me give you just a little plug again. From the K&R side, one thing that you get is not reactive. So you guys all know when you go to your tax person to go file, and it's already March of 25, and they say, oh, you owe $20,000 or $50,000. You say, wait, what? I thought we were doing stuff. K&R actually meets with you June of the year before when you request, and November. So you can actually plan ahead to say, okay, what am I doing to minimize my tax liability when I come meet with you in March? So again, huge benefit there just from an operations side. The retention of key employees as you're selling your company, you should know that's a big part of what is going to likely be required of you if you have any form of structure. If you're just a single book, meaning you have an LLC and you're the only provider or producer, maybe not as pertinent here because your book can be transferred. But let's say you have 3, 4, 5, 6 employees or people that work with you, and you're kind of the key relationship to keeping that group together. Well, that's going to be a contingent piece of the purchase of your business, because they're going to want to make sure that stays together while they try to recoup their investment on your buyout, right? So a lot of times that comes with a non-compete, by the way. Non-competes mean, hey, you cannot operate in this space for the next 3 to 5 years. Non-solicit is another term that people often hear or think it's part of a non-compete, which is, hey, you can't reach out to clients. You can't reach out to people that you've done business with. Anti-piracy is one that says, hey, you can't be stealing employees or contractors or vendors that you were using. You can't be going and pulling those people. And then obviously a confidentiality provision, which is where you say, hey, you can't take information that you learned and use it to your advantage and to my disadvantage after you sell this to me, right? So those are all pretty common concepts within a buy-sell agreement, whether it's a membership interest purchase, stock purchase, or an asset purchase type of agreement.
And that last point was just kind of to wrap it all together, right? All of these things should complement each other, right? Operating agreements, buy-sell agreements, estate planning documents, right? Everything should complement each other. We've touched on kind of the difference between asset purchase agreements, stock or membership interest purchase agreements, hybrid agreements. We've talked about the first two quite a bit. Hybrid agreement is something that Tim had mentioned, selling to maybe a larger group, whether it be Integrity or somebody else, right? Sometimes that compensation can come in as a combination of not only are they paying you cash, but maybe they're paying you some equity in their company, right? In exchange for, or vice versa, right? It could come with a combination of those components. And again, a huge portion of that is from a tax consideration standpoint, but those are, those sorts of structures are available.
I do want to just go back real quick, if you don't mind, Cameron.
Yeah, please.
Okay. People have heard these terms. Let me just break it down. Asset purchase is literally what it sounds. You have an LLC. Let's call the LLC Bob because we're talking about book of business. It's truly a separate person, right? Your LLC is a separate person. Your tax designation, whether you tax as an S corp or tax as a sole proprietor or partnership, is the close that you put on Bob. Bob has close. That's his election of his tax status. But Bob is a separate person. And for an asset purchase, what you're doing is you're taking everything away from Bob, and they are going to put it into a new separate entity that they've created for this sole purpose, right? That's typically how it's done. Or they absorb it into their existing LLC. The reason for that is they want to leave Bob with all of his issues. If Bob's been in a nasty relationship, if Bob has, done things that he shouldn't have done, well, guess what? I don't want to deal with what Bob's done in his past. I'm going to take all the good away from Bob and put it into my business structure or my new LLC and leave Bob to deal with his own issues. Asset purchase is that. The stock or membership interest purchase, and this is why it's less common, but in some cases, like Zach has mentioned with UHC, if you've already had a transfer of the book once, what a stock interest is, you literally say, hey, Bob, I guess we can't take the things away from you, so I have to now take you over. So I now inherit Bob and all the things that Bob has done and is. If Bob has skipped out on his lease, for example, now I'm responsible. If Bob has not paid employees correctly, now I take over responsibility. That's why most commonly it's an asset purchase. In some instances, though, you have to do a stock or membership interest purchase agreement. And in those cases, you can bet if you're the seller, the buyer is going to require some pretty heavy indemnification language, some carryback, so they hold back some of the purchase price, or they're going to require a pretty hefty tail insurance piece to cover those liabilities. So again, asset purchase most common, and we like it from a seller side too, because you can continue to use that LLC from a tax perspective to run the payments through it. You can use your S Corp election on top of that to run your tax advantage structures through that. You can start operating a separate business that's unrelated to the one you were running. Bob can now become a new person. You could buy a piece of real estate with Bob. We don't care. And you can use that to reduce your taxable liability. So again, from most standpoints, an asset purchase is going to be your go-to. In every case, you know, Bob's gonna still continue to have the issues he has, and somebody's gonna be responsible for it, whether it's the buyer or you, is, you know, the seller is the question.
Yeah, it was great distinction there. So, and I know we've touched on some of this as well, and I think that this touches on a recent question here. You know, what you're going to see in these agreements is clear valuation terms and payment structure, like we've talked about, non-compete, non-solicitation clauses, as Tim mentioned, confidentiality, right? What is expected post-sale from the seller and of the buyer? Those are going to be more pertinent to the seller, right? Obviously, a buyer doesn't want you turning around and opening a new agency right next door and undercutting everything that he or she just bought. And then there's going to be a, you know, who and how are we going to handle client contracts? I know there was an earlier question about it's that same question. Who communicates to the existing clients, right? That's worked out as part of this process. It could be you as a seller. It could be on the buyer. It could be a combination, right? A joint, especially if the seller is going to stay on for a little while. There's all of that is outlined and negotiated as part of the purchase agreement. And then closing conditions, representations and warranties, right? Some are going to be more pertinent than others depending on the type of the sale, right? If it is an asset sale versus a membership interest sale, if it's a membership interest sale, there's going to be, I would expect there's going to be a lot more due diligence. There's going to be a lot more, you know, heavier indemnification, heavier reps and warranties. Not to say that those don't exist with an asset sale, but just the nature of the sale will determine the extent of some of all of that. But you can expect to have discussions touching all of these and more as part of leading up to the close and even following close. And these obligations could stay in place for 5+ years, depending on, you know, the time of the non-compete, non-solicitation, etc. Where did the control go? Oh, there it is.
Some of the fun legal pitfalls, we'll rush through these so that you guys, if you have any questions, we've already talked about no formal succession plan, outdated or missing entity documents. That's one that we can easily clean up, and we do often before somebody gets ready to sell. Hey, I don't have meeting minutes. I don't, whatever it is. I don't have the right documentation for my LLC. We can help with that. We get it squared away. There's things I can say to you that we could do on a general call, and then there's things that we talk about in depth when you're on a private discussion with us that we say, hey, this is what I would do if I were you, right? We love talking about those things because it doesn't really matter what I could tell you theoretically you could do. It matters what you actually can do and should do, and what I would do if I were in your shoes is a big part of that. And then unclear ownership or partnership rights. Again, some people start these in tandem with others, and maybe it's not clearly defined. In your case, you have books of business that you're generating, so it's pretty easily identifiable. Sometimes it's the expense allocations that can become the issues there. But again, that's where Garron had talked about best case scenario is you set up an LLC, Bob tax as an S Corp, with then your entity number 1 and entity number 2 underneath. So that way you have the flow through taxation and you have the separation of your 2 books, but the protection of the S Corp up top, tax structured. So, okay, unassignable client contracts we've talked about, licenses we've talked about, mixing business and personal finances. Here's a quick one. Don't do it. Pretty simple. Set up your LLC, use your LLC as your taxable entity. And when you have your bookkeeper in place, let's say, oops, I used my business credit card for something I shouldn't have. Guess what that's being tagged as on your bookkeeping? An owner draw. That becomes then an owner draw. You shouldn't have used your business card. You did. Oops. Now that becomes your draw to yourself versus a business expense, right? Ignoring regulatory compliance. Again, a lot of companies start out, you guys have heavy regs which you have to comply with, and then there's regs that you don't even think about, like, hey, am I paying my my independent contractor or employee correctly? That's a compliance issue that may not pop up into your head just because when you're first running a business, revenue is king. I got to generate revenue. Okay. We are pumped for you guys. We have a QR code similar to what Garron had. Funny enough, Garron, we were thinking great minds think alike, apparently. We love talking to you. Again, we have our Counxel on Call program. We do it at $99 a month. That's the crazy part. So up to 1 hour of legal strategy a month, which would usually cost over $500. Contract reviews included. One demand letter or demand letter response is included. We've loved doing this with our clients. It's been a great program. If you have questions, we'd love to jump on and help. Cassandra, thank you for sending that over. I did see another question. So the state I live in doesn't matter for using Tim or Garron's agency. We can do a lot on the transactional side. We have licensure in 3 states currently, where it's New Mexico, Arizona, Utah. We can do contracts and other things. But if it goes to litigation, that's where we really get into heavy issues. We do have to provide a disclaimer, which I don't know if we had a disclaimer on here. None of this is legal advice for your direct situation or tax advice. We would need to meet with you individually. So there's my disclaimer.
And it looks like there was another question so Mike had asked, and just clarification here, if I sell my B of B in my LLC, I keep my LLC apart from the B of B. So yes, Mike, in an asset sale, that's exactly what happens. You keep the LLC apart from the book of business. That's the asset that you've sold off, and the LLC remains. If it's a membership interest purchase agreement, they are buying the LLC and everything that goes with it, right? And so you are left with, I mean, nothing in theory from that standpoint, unless you partition that out. But generally speaking, in an asset sale, Mike, you are correct. You keep the LLC.
I like to give the analogy. It's like Bob has his wallet. In an asset purchase, you're giving the wallet over, right? That's what you're transferring over. You keep Bob. So yeah. All right. Thank you, Zach. Appreciate you guys having us on.
Yeah.
Hey, yeah, thank you guys. That was super informative. I think you answered probably 5-10 years worth of questions I get all the time at one place. So this is great. I know I've had people texting me and calling me separate saying, they hope this is recorded. So I will answer that again. This is recorded. It's going to go on our website as well. For those of you that have a Fidelis Agents portal login, feel free to log in there. This will be put up there. And then Gabby, I'm sure you'll be sending a follow-up email, and we'll make sure to put in KNR, Garron, and Cameron, Tim, Counxel's information. So if anybody wants a consultation, they can reach out. Like I said, I wouldn't be using these guys if they weren't amazing. They all do amazing work. So rest assured, if you reach out to them, they will take care of you guys. So with that being said, that's really it. I think we've answered all the questions. So if you have anything else further, you guys can reach out to us at Fidelis, or if you got their information from their QR codes, reach out to these guys directly. So thank you guys so much for your time, and we'll hope to talk to a lot of you guys soon.
Thank you.
Thank you all.
Thanks, guys.